We're back in overtime. Oil prices jumping today with the Keystone Pipeline down and Russia threatening production cuts. Famed oil trader Mark Fisher, he's the founder and CEO of MBF Clearing Corp. He joins me now. Fish, welcome back. It's good to see you.
Hey, Scott. How are you?
I'm good, thanks. I understand you made a series of trades today at the close of the market. Can you give us the specifics, exactly what you guys did?
Well, I hate picking bottoms because, you know, picking bottoms or picking tops is usually where you get yourself into trouble. But today was too irresistible because I think the setup was too good. So we kind of bought everything today on the close. We bought crude, heating oil, RBOB. I'm sure we bought some natural gas. We bought everything today. It just, again, typically you go broke buying bottoms and trying to pick a bottom. But today the setup was just too good for us.
When you say that, for those who are watching us, and even for, whether they're more experienced or more novice investor, what does the setup look like that keyed you into today being the day?
Well, again, I'm usually when I'm right, I'm usually early, and I'm usually either really right or really wrong. And I'm probably, now, again, Scott, I always say this when I come with you, I'm probably going to go on TV and look like a fool tomorrow when everything, gets destroyed. But number one, you've got a situation occurring where the weather's finally getting colder. You had California power prices over $400. Your natural gas prices and cash in California over $45. You have the situation occurring where you're coming to the end of the index roll in energy that ends kind of tomorrow. You've got a big rebalancing at the beginning of next year, where at these current prices you're going to have to buy oil in those indexes. The SPR is down to a level where the administration said they were going to be buying oil around $70 a barrel. The SPR reserves, basically all the selling will probably be over in the next month. And you've had a perfect storm in terms of weather up until this point, why the prices have gone down.
Some say that oil, and all those are obviously valid reasons that, you suggest could mean that these commodities markets go higher, but some suggest ultimately you need a Fed pivot to push a more sustainable rally. You buy that or not?
Scott, you know with me that I'm probably one of the most out-of-the-box people that you know, right? Just in life, forgetting about trading, right? With that being said, anything that people focus on, yes, you could have a short-term reaction from the Fed, whether they pivot, not pivot, CPI, what they do on Wednesday. But that's all in the market. I kind of like to take a step back and look at what people don't look like. So to me, for instance, I think you guys put a chart together with me, this past day. The number one thing that correlates why the price of oil has gone down in the past 3 to 6 months has been because of the Iranian tensions. I mean, if you look at what goes on here, except for maybe one blip, as it's gone down, that it looks less and less likely that there's going to be a deal between Iran and the U.S. and the European nations. The price has gone down. I mean, with all the protesting and all the rioting and all the all the crazy killings and all the insanity that's gone on in Iran, obviously it looks like the deal's not going to get done. The price of oil goes down. But now it's $70 a barrel, $71 a barrel. The risk reward is just too good. At $85 a barrel, it was probably much more of a crapshoot. But what do you really risk? It's risk versus reward. What are you risking versus what you reward? And again, this time last year I was on talking to you about not this winter's natural gas, but next winter's natural gas. And again, if spot natural gas is trading $6.50 today at the hub right now in futures, and again, there's no shortage of natural gas. There's a shortage of pipelines. Like in Texas a month ago, where there's no pipeline connectivity, they were inundated with so much natural gas that the price went negative. At the same time, in Boston, for this coming winter, the price is $28 because there's no connectivity to it. Next winter, natural gas, again, is going to end up being, to me, a great trade because of the fact that no one is really going to go ahead and want to step up and get short next year's natural gas. And is Europe really going to go through the same constrictions that they're going through this year? Are they really going to suppress themselves and have to do everything? So next year's natural gas is probably a buy in January, December, January of not this winter, next winter. At these levels, $70, what are you really risking? Okay, can the Fed come in and raise rates? Yes. Does that really matter? I don't really think so because everyone's focused on it. Markets don't move on what people focus on. Markets move on what people don't focus on.